Good morning, traders. It's Thursday, February 1st. Taking a look at the charts, equities having a little bit of a bounce after yesterday's sell-off. There's a lot of kind of news going around, a lot of emotions yesterday. We saw our fear index here kind of popping up, our panic selling indicator. We saw the market dip down to give us these lime green bars here telling us the market's moved a little too far, too fast, and it's a short-term oversold. We saw this back over here when the market came down to the 20-day. We end up getting a very strong bounce off that level. The NASDAQ is pretty much the same. If we look at the NASDAQ, it pulled back to the 20-day, just like we've seen in the past. We've got panic selling, and we'll see if this market wants to recover. Now, if we take a look at our sentiment charts, it doesn't matter if it is the NASDAQ or this is the SP 500 or the NASDAQ. We're looking at the sentiment chart here on the right-hand side. If we take a look here, you can see we got a red bar yesterday. And we've talked about this many times before. This is telling us when people are freaking out, when they're panicking, dumping positions, and more or less starting to buy positions into 3 times inverse ETFs or buying put options, betting on the markets falling. And of course, when we see people start, more or less, we see blood on the streets or people panicking, just like we're seeing now, the market tends to have a rally and go the opposite way and take their money. So that is the setup we are starting to see again here. Now, this could last a week or two. The market could pull back more. We'll just have to see how it goes. It's definitely been a very strong move. Eventually, one of these pullbacks in the market will be the one that breaks the uptrend and a new downtrend starts. But we never know when that's going to happen. A lot of people thought it was right here, hence they were betting on there. A lot of people thought this was going to be the top. And a lot of people are thinking that this is going to be the top, but the market can just keep going higher and higher and higher. Keep in mind, these indexes are at all-time highs. There is no overhead resistance, and they can keep running up, putting people who are betting against the market way offside, and it can be very, very painful. So we'll see how things unfold. I wouldn't be surprised if we see more fear in the market, more pain come through here. But we'll see how the market unfolds and if we're going to recover. If we go and take a look at the markets today, we are seeing the Russell's up almost 1%, so it's having a nice pop. Let's take a look at the Russell. Obviously, this is a fast-moving sector. It took a big hit yesterday. Yesterday, we did see, we're seeing a lot of interesting news come across. If we take a look at our routers here, the banking sector, KRE and financials, they took a pretty big hit there yesterday with some of the banks talking about cutting dividends. So that's one of the first early warning signs that these big institutions are having difficult times. They want to start trimming their dividends because they're not making as much, and they know they're not going to make as much when we go into a recession. So they want to stop giving away money because they're going to need it. More or less, we've got global passive equity fund has eclipsed the active traders. So everybody is moving away from the COVID bubble of everybody trying to actively trade and losing their shirts in 2021 all the way till end of 2022. And of course, anybody who really just bought and held last year, 2023, would have done very well, which is the passive people. Just buy and hold and you would have done well. So we're finally seeing everybody pile back into the big old kind of herd mentality. Just buy into the market and leave it. Just set it and forget it. And this is one of those warning signs we talked about. This is the complacency move. People are piling back in, realizing that they can't trade. It's very difficult to actively trade, and they're just going to be like, just dump my money in and I'll just leave it. I'll be fine. And of course, as they all get back into this strategy, this is when the market goes for a multi-year correction, and then they lose their shirts. Job cuts, more than double in January. Things are slowing. I know all kinds of different businesses that are coming to a grinding halt. Layoffs are happening. I know bosses who are super happy to be firing some of these terrible staff. You can't get employees, and the ones you have just don't care. There's zero respect. They don't care about anything. They just call in sick anytime. The bosses are starting to love to get rid of some of their employees, and we are seeing job cuts picking up across the board. That is another sign that businesses are slowing. So those are some interesting things. The Fed holds rates steady. I mean, not anything too surprising there, but people get caught up, especially around the Fed. They get caught up in the Fed news, And because the market moved down on some big tech earnings, and of course the Fed was out as well, it caused a lot of people to just feel like everything is bad news and they're dumping everything. So that is one of the reasons why we have a lot of panic yesterday in the markets. If we look at the VIX, VIX had a big pop there, up about 7.5% yesterday. It's back up into these levels where the stock market typically has been finding a bottom and then rallying from. So we are into that fear level where people are really nervous. If we take a look at the put-call ratio, it didn't close anything too high. It's still within the norm, but it is kind of inching its way higher. I wouldn't be surprised today if it goes higher. People will see the big sell-off yesterday, and then they're going to see the Fed was out and all this other news, and they're going to get super emotional, and they're going to be like, I'm betting on the downside. The top is in, and we'll probably see people putting in lots of puts, and that could be one of the final straws. Typically, people sell their positions and then buy leveraged positions. So when the leverage plays like the options spike, usually that means we are really close potentially to a market bottom if this trend is going to stay up intact and continue to go higher. If we go take a look at bonds yesterday, they're up again today. Actually, I'll pull up the futures here. They're up about 0.8% today. They're finding kind of that safe haven type of play right now. Fed not cutting rates, people are piling into bonds as a safety play, and just because I think nothing's happening with the rate, people are moving in there in preparation for eventually the rates getting cut. So overall, bonds moving higher. Again, we've talked about this big pattern. If we zoom way out here, this could put in a rally and build out a very big base here. We could draw a line through here, and this could eventually turn into a big base. Maybe the market consolidates, or maybe it comes up here and consolidates. I do feel like this will be a very big, major rotational basing formation that eventually I think we could see bonds take off again at some point. But at this point, they're still in a downtrend, but they're starting to shift towards an upward bias. And I haven't talked about this in a long time, but when there's serious panic on the streets, we usually see natural gas move up, and it moved up yesterday. Not much, but typically if everything is red, we'll tend to see the dollar, we'll tend to see natural gas move higher. As I don't know why natural gas does, but it does during some of the biggest sell-offs in the stock market. Natural gas is the one thing really moving up. If we take a look over at crude oil is pulling back a little bit from up here. It kind of had this little pop and squeeze, and now it's hit this next resistance level. If I just draw a line across here, you can see it's very significant pivot zones on the chart. So it's hit resistance, and we'll see if it's going to continue to ramp up or if it is going to eventually roll over and head down. The big picture of oil is really just sideways chop, trying to figure out, I think it's just kind of waiting for things to slow down even more as we go into a recession, and then eventually it falls off a cliff as travel comes to a grinding halt, business travel comes to a halt, products aren't selling as much. I actually talked to a shipping guy the other day, and shipping costs, so I used to import 40-foot containers from China, and it used to be about $4,500 a container. During COVID, in the last couple of years, they were about $12,000. He was saying they went all the way up to about $17,000 to ship that same container. And he says now they're back down to pre-COVID levels, and shipping has slowed down. And that is a major leading indicator that business is slowing. People aren't ordering as much for their companies because they just don't see the sales.